Oh no, I read that. Yeah. The Dutch company got taken over by the government. Yeah,
It's to a person.
it's almost always, That's amazing. That's the other end. That's whenever I see it. One of them.
All right, hey everybody, ready to get started? I'm gonna mix it up a little bit today. This will be a little different than our usual talk. We do this series pretty regularly, so you're gonna be my guinea pigs for the beginning of the year. We do this talk a lot, and we record them all. So there's lots of old versions to watch if you want to see the old one too. My name is Josh Baer. This is the How to Meet Investors or Intro to Fundraising talk. We do a different series of talks every Tuesday. So this first Tuesday of the month is How to Meet Investors, Intro to Fundraising. The third Tuesday is Intro to the Austin Startup Scene. So that's for people that are new to town, new to Austin, looking to plug in and get a job at a startup or work here or anything about that, some fundraising too. We have a happy hour after that that's for everybody that's new to Austin, and it's a good time to meet other people and things like that. We also do a session every month about how to become a mentor or an investor, how to get plugged in here through all of that. So thank you all for coming for this. This talk, like I said, in particular is about how to meet investors, and that's a big reason why a lot of people come here and why they're plugging in. I want to today go through this blog post that I wrote last month about kind of looking at the state of the market now and what it really takes for a startup to raise $500,000. And I'll tell you why that's the number that I picked there. And that's the most common situation that I see companies are in. That's usually when they're coming here is when they're trying to go raise about $500,000 or $1 million. So I'm gonna go talk through that, and then we've got Morgan Flager coming in a few minutes, and he is one of the top VCs in town. He's a partner at Silverton Partners, one of those active firms in town. We've done lots of business together, and so the second half of this is just an open Ask Me Anything or Q&A session where we'll open it up and you guys can ask anything you want. It can be about fundraising, about your startup, about how you fit into this criteria that I'm gonna go through here in a minute, about Austin, about VC firms, about Silverton, about Capital Factory, about anything like that. Cool. How many of you went on the tour today? A bunch of you. Good. Awesome. So I'm going to assume you know a bunch about a Capital Factory already. I'm not going to spend a ton of time talking about that. How many of you have a startup you're working on right now? Great. Most of you. How many of you have raised more than $1 million for a startup? A handful. How many of you have raised more than $1 for a startup? All right. Cool. So I wrote this blog post that says, what will it take for your startup to raise $500,000 in Austin in 2017? I do think this is for Austin. That's really all I have any serious credibility to be able to talk about. But at the same time, I don't think Austin's actually that different than that many other places. It's not Silicon Valley, and maybe it's not New York City. But most other places are going to be similar and actually probably harder than Austin. Austin's got it pretty good. Why $500,000? That's kind of just a minimum number. It's kind of like a lot. I mean, a lot of people will be raising more money than that. But if you don't have that much money, that's like basically like a year's worth of runway in Austin for a small team. And you shouldn't raise money based on time. You should be raising money on some goal you have of what you're going to accomplish with it. But it's hard to accomplish that much in less than a year. And really, one of the other reasons I brought that up, and when it says one check is better, is what's happened over the past couple of years, and I'm probably more at fault to this than anybody for helping encourage this to happen, is that people are doing more and more of what's called a rolling close, where they kind of just like get somebody to give them $25,000 here, and someone else gives them $50,000 here, and like every month and so they end up fundraising continuously for a long period of time, and they actually never know how much money they're going to have all at once, and so they can't make any big plans or spend the money smart because they're just living kind of check to check. So it's really inefficient. In some ways, that's being scrappy, and there's some good aspects of it. But I think one of the takeaways I've gotten out of that over the past couple of years is I think most companies would be a lot better off if they waited a little bit longer and tried to put together one big round so they got a big chunk of money at once. And that's where $500,000 comes from. That's just kind of like the minimum amount of money that you'd go do that with. And another thing that's really important to keep in mind is just this all takes a lot of time. And so most people that I meet show up and they think they're going to raise $500,000 or $1 million in about a month. And that's completely unrealistic unless you already know all those people that are going to write that check and have all got it all lined up. It really takes many months. It usually takes about 6 months. Sometimes it can happen faster, and a lot of times it takes longer. So you have to realize coming into it, if you don't have 6 months of runway, when you start going out to raise money, which is going to feel bad because most people don't. That's like, wait a minute, I need money. Why would you tell me I have to already have money? But if you can't survive for the next 6 months, you're probably not going to survive through fundraising. And when you're trying to attract money and get people to invest in you, being desperate is not very attractive. So like being like about to run out of money and like that doesn't, people, they're afraid to give you money if you're about to run out of money, right? So you got to like come from a position of strength. You got to find some way to scrap together a little bit of money. Now maybe that's you go get. They call it friends, family, and fools. Like maybe that's some family money or some other thing that gives you a little bit of runway, or you save up some money, but it's important to understand that you need to do that. So what are the 5 things that it takes to raise $500,000? And these are very much in order. It's not that you necessarily need all 5. Sometimes one thing will overrule the others. But it gives you, it's just a good framework to think about. There's always exceptions. There's always companies that maybe don't meet these criteria and they get funded anyway because all you got to do is convince somebody to write you a check, and that can happen. But this is from seeing thousands of companies, like a lot of them, and what I think it really takes. So one is a team to believe in, and that certainly is the most important thing. Every investor you talk to will tell you that the thing they care about most is the team. Now, I don't know if everybody actually lives up to it, but that's pretty common knowledge. That's what you're supposed to say. And so it really is, it is about people, and it's a people business. And so the first thing they're going to look at is the team. And if you have the right team, nothing else matters. Right? So example, if you have, like Data.World was a really interesting company that was recently launched here in Austin. It was launched by Brett Hurt, who's a serial entrepreneur. He started a bunch of other companies, some that have gone public. He was able to pick from the best talent in town and grab great senior people from HomeAway and from Bazaar Voice or from other places that he'd worked with for many, many years before. They've all worked together for a long time. They've all built a bunch of companies. They don't even have to tell you what they're going to go do. And everyone wants to go give them money, right? They're like, whoa, just please let me invest, right? So it's like nothing else matters. If you have the right track record, that's it. That's all that matters at some level. When it says to be able to raise money, that doesn't mean anybody will give you money. And you might still have to prove some of those other things to get the money you want from the right people. But the question here is just kind of like, what's it take to get funded? And if you have the right resume, you're going to get funded. Okay, so now most people, you wouldn't be here if you had that resume. So we'll assume that you're the next step, right? So now having a $1 billion growing market, being in a really big industry, that's really important too. Because these smart investors know that both that's the easiest place to make a lot of money and the easiest place to invest, and that's what's exciting. That's what everyone's excited about. So it's really hard to get investors excited about something boring. It doesn't mean you can't, but like you're gonna have to work harder and you're gonna have to go figure out how to talk to investors who find that exciting, who actually understand that thing that you're talking about or that you're doing. But being able to convey that you're in a really big market that's growing fast is really good. My first business that I started when I was a college student was in email marketing, and that was in 1996, and which makes me feel really old. But email marketing has been a damn good business since 1996. It's grown a lot and continued to grow that whole time, right? And so that was a great time to get into email then, and it's grown a lot. Another company I was really fortunate to get to work with is WP Engine, which is a WordPress hosting service. WordPress is a big growing market. When we started the company about 5 years ago, WordPress powered about 10% of all the websites on the internet. So it was already a huge market. That was massive. It now powers about 25% of all the websites on the internet. Think of how much growth that was over the past 5 years. Like So like it's just in an amazing market where there's just tons of customers all the time, you know, like that's a good place to be. Meaningful customer traction. So generally, again, this is somewhat stack ranked. So if you have a great team, you don't have to have traction. If you are attacking something that's super exciting and interesting, maybe you don't need to have traction either. But if you don't have those other things in particular, then you're definitely going to have some real traction. So you're going to have somebody that wants to pay for it. You're going to have proven that you can do something and proven that somebody wants it. Meaningful is different for different kind of businesses, and we can talk about some of those examples, but it's got to be meaningful that shows that. And really what most investors at this stage are just looking for is like, it's real. Like people, the dogs eat the dog food. Like people really want this. They will pay for it. It's not just a demo or your brother-in-law or like something like that. Like it's a repeatable thing they can expect to scale. They expect those results to continue from other people. Social proof from a key investor. So that can often be really influential. One of the best examples of that here in Texas is like Mark Cuban, you know, like really big name. He's a Texas investor, and like having Mark Cuban investing in your deal or leading your deal turns heads, and a whole bunch of other people will be more likely to invest just because Mark Cuban's leading the deal. I wish I could say the same thing for me. I don't think it's probably not true, but there are a lot of people like that. Brett Hurt, who I mentioned already, would probably be another example here in Austin. If Brett's leading your deal, he doesn't lead very many deals. Brett's leading your deal, a whole bunch more people are going to be more likely to invest. If Brian Sharples, the founder of HomeAway, is leading your deal, it's going to be a lot easier for you to raise money. So that's something that can make a big difference. And then you're going to need to have a minimum viable product. You're going to have to have built something that's useful to someone, something that people are willing to pay for that actually does the job. And again, it's possible you'll get funded without that. It's very unlikely these days. And you know, again, unless you have one of these other things that trumps it, you've got a super, super strong team. Maybe if somehow you can have traction without a minimum viable product, it is possible. I've seen it done. That would count, right? If you can go get people to pay you before you built it, that sure as hell counts. But you're gonna have to find ways to do those things. So digging in on those a little bit more. So a team to believe in, you know, what's that really mean? You know, like I said, the obvious example is, you know, a serial entrepreneur who's built a whole bunch of successful companies before. And at some level, you're like, well, why are we even talking about that? Like, they can just fund it themselves. They don't even need money. But that is true. That's like the easiest thing. And it's also a reason why a lot of people apply to accelerators. Like Capital Factory or Techstars or Y Combinator, right? Is because they don't have those connections, they don't have that experience, and through that, they're hoping that they're both going to learn a lot and then get introductions and some of the social proof and other things that help them to grow. And so, one of the first things that investor you meet is going to ask, or at least they're going to be asking themselves, is what has this person accomplished? What have you done? And that's kind of how you want to stack rank yourself. And you need something big. Some big bullet there, and that's what is going to make this matter for you. If this bullet is going to be a reason why people are going to invest. So some good examples of that would be like, well, I built a business just like this before. Well, that's pretty good. Not people like that, you know, like, okay, you know this, you're very much likely to be able to go do something like that before. Again, I hate to say it, use these big names like this but they do get this credibility. Like, I worked on this at Amazon or at Google. Like, that goes a long way, especially here in Austin. Like, it really does. I've been working in this industry for 5 years. I'm leveraging some really relevant experience or relationships I have that other people wouldn't have. Like, that's exciting. That says you've got some key thing there. This is my family business. I've been doing this for generations. I was born to do this. I've gone to you've got some story about how you like climbed to the top of Mount Kilimanjaro to like find the hidden jewel that was like the thing you needed, but that shows that you're really, you know, passionate about it. You bring some other thing to it. Or sometimes it's just some other credibility, like some people give a lot of credibility to professional athletes or to people in the military or things like that show that they have some other kinds of incredible discipline or personal work ethic. And then the why ties into that as well. And I think you'll find that, you know, the really great entrepreneurs and the people that investors get excited about backing, a lot of times they've got a real reason why they're doing what they're doing. And it's not just, I think we're going to make a really lot of money. And I think you find, like, if you go into investor pitches leading with, like, this is the biggest opportunity you've ever seen, and let me show you how it's going to make all this money. I mean, they have to understand that by the end of the conversation, but, like, that's kind of like what everybody would be saying to them, right? You know, like, everybody thinks their idea, that people want to see that you're really passionate about it and that you're the right person to go do this. And so that might be that you're personally affected by it. I know that's one of my own personal mottos is I want to work on things that affect my life personally. or somebody in your close family or friends were affected by it. Something that you've got some long history with and you've always been doing, and you've got all these other stories you can tell about why you're so passionate about it. Or maybe that you've done something similar in a different industry and you're bringing that to what they do here. So those are all different examples, but those are the kind of things that I hear. And when I hear those kinds of things, then we're like, wow, this is really, really interesting. And if you don't have one of those things, then what that just means is like, this isn't one of your bullet points. Like, they're not investing in you because of the team. That might be that's okay. That might be what it is, but that's where that was at. So one of the things I said here is, two things really important. So one, a lot of people don't realize that one of the easiest ways to improve your company is just to add somebody great to your team. And a lot of people think that's really hard or inaccessible to them. Like, how could I go I'm just some tiny little startup. How could I go steal the VP of sales from Spreadfast, to come run? But you can do stuff like that. You totally can. I mean, it's all up to you and how good of an opportunity you think your company is. But that happens all the time. And that's a great way to really increase the value of your company, is go find someone else that can join the team that can make it more valuable. And then another thing is that if you can't do that, then if your team isn't strong, then you're gonna have to show traction. It's really unlikely you're gonna see funding without showing some kind of traction if you don't have some other kind of experience. Okay, so next one is market. So being part of a $1 billion growing market. I think I talked about this one a good amount already, but really when we say $1 billion market, I think what most investors in Austin would be looking for is that you can sell this thing for $100 million. Somebody would buy it for $100 million. It's a rough number. I don't know, maybe it's $50 million, maybe it's $200 million. It's that order of magnitude. That's the kind of thing where someone's gonna go invest hundreds of thousands of dollars or millions of dollars and end up making money, and make 10 times their money on it. Right, so that's the math that somebody's trying to do. Obviously, makes a $1 billion company, it's even better, right? Everyone makes a lot more money, and everyone wants to have those wins. But the math they're doing is, can this be a $100 million company? At the time, when you're starting to raise $500,000, $1 million, $2 million, that's the kind of thing people are starting to ask. And so another thing about being a big company means that the investors can imagine who might buy your company. Right? There's other companies that would compete with you. It's not bad that all the big companies in the world want to compete with you. That's usually a really good sign. So you should be able to name, like, hey, if we're really successful, this company's going to want to buy us, and this company's going to want to buy us, and that should be really credible. And they should be the kind of companies that buy people. What does a company look like that sells for more than $100 million? Well, it's probably got $10 to $25 million in revenue. Or millions of highly engaged users and viral growth. Is probably raised less than $15 million at that stage, at a valuation of less than $50 million. Just kind of giving you a ballpark. That's where you're trying to get to, and to get to that spot. So many investors will say they'll take a great team and a crappy product over a crappy team with a great product. And that gets back to the thing about being about people, right? Because crappy people can screw up a great product. And great people can take a crappy product and turn it into a good business, or pivot it into something else. Find a good business there, so keep in mind it is really about people. Meaningful customer traction. So like I said, it's extremely rare for a first-time entrepreneur to receive any significant amount of funding without showing significant traction first. We'll see if Morgan will come up here in a sec. Maybe he disagrees with some of this, but that's my experience. Is you're going to have to show some kinds of traction. Traction means revenue. Usually here in Austin, usually it's thousands, $10,000 a month in revenue. That's a good start. Whether that's one person paying you $10,000 a month or 10 people paying you $1,000 a month. So that's kind of 20 customers, $10,000 a month. That's a good starting point where then, okay, you're fundable. This thing is validated that somebody will pay for it and starts to be real. And if you're B2C, it's not impossible, but it's hard, and it's harder here in Austin. Now there's B2C businesses like Aceable. I got my hoodie on today for. They sell a product. It's B2C, but it's not like when most people say B2C, they're talking about B2C things that don't charge money, like games or apps or basic social networking or things like that. Aceable doesn't have this problem. It's like a cash machine, right? It's like it costs them, I think like I don't know their exact numbers, but it's like it costs them $1 to like buy the licensing fee to the state, and then they sell it for $19. So that it actually makes money. But then there's like Taga, which is a fantasy soccer company here in town, and that's a little bit harder, right? Because their money comes down the road. What they need to show is really engaged users and people coming back and using the product a lot. And one of the things I've learned that I see is a common mistake here in Austin that people in Austin don't get is they come trying to build a consumer thing and they don't even know how to talk the consumer language. So if you're pitching investors on consumer products, there's a vocabulary that you should have, and metrics and certain things you're looking at. And if you're not using these words and talking in those languages, then the investors are going to know you really don't know what you're talking about. You're not looking at the right things. So, for example, it's not downloads, and that's not something investors are usually excited to hear about. Hardware, whole nother batch, but hardware actually getting a lot more like software, I think. Just it's getting more modular. The price point's getting down. It's more easier to get into. It starts to look like about the same amount of money getting started with a hardware product. Often is about $500,000. Maybe it can be $1 million or $1.5 million. So there's just some different examples. Social proof from a key investor. The first check's always the hardest, as you can imagine. That first person investing you, they have to believe they're doing it based on just themselves and not counting on anybody else's kind of like, well, this person looked at it too, or anything like that. They have a lot more risk because they might invest in you, and then especially if you're doing a rolling close and nobody else does, and then now their money just gets flushed down the toilet. So that's really the hardest, and it's important who it's coming from. You want to get your first check from someone that's going to make other people want to go write more checks. A lot of people are going to ask who else is an investor. So one of the best places to find that first investor is somebody that knows you really well, like somebody you used to work for. This is a good reason to impress your boss and leave on good terms. You might come back to them later, and often your CEO might be someone who could be your angel investor, right? And if you do a really good job and impress them and you leave on good terms, and they're going to want to invest in you. And I'll tell you, there are a lot of CEOs in town who do that all the time and are very active angel investors. And they might know other people who are. And then if not, their endorsement's going to go a long way, right? Having the CEO that you used to work for speak up for you matters a lot to other potential investors. And then I already mentioned Accelerators as well. That's another great way to meet investors. There's the Central Texas Angel Network here in town, which is an angel group, a group of angel investors. They act a little bit more like a professional investor, and they're very, very active. They write lots of checks. And then also, another great source of social proof, it doesn't happen that often, you can ask Morgan about it later as he comes up, is occasionally you'll see VCs participate in these early seed rounds where they might put in $250,000 or $500,000. And that's not normally the way they're doing a lot of investing, but that's a strong signal too. That says a lot if you got a VC to put some money in early as well. So finally, the minimum viable product. Hopefully this is a term that you're all familiar with, but this is the idea of just enough. And minimum viable product does not mean a crappy product. It doesn't mean that it's not good. It means it should be great. It just means that it only does the minimum amount of stuff it has to do. It means it's, and so what was the minimum amount of stuff you had to build something great? And that's what you want to show. It's be a big mistake to build a crappy MVP. But that's what it is. And it's really hard to know what that is usually. Usually you don't know. Usually you think you got to build everything. So figuring out what's the smallest amount you need to build is really important because you really have very limited resources. The MVP, and one thing I said in here is, the MVP is not actually the requirement, it's customer traction. And so usually you can't get customer traction without the MVP. There are cases where you can, where you get like contracts in advance or commitments or other things like that. And those are very valuable and still worthwhile. So what if you're not fundable? Well, I'd say, pretty much all of the biggest businesses in the world do end up raising money one way or another, at one time or another. Lots of them bootstrap, and lots of them take a long time to get there. And so sometimes it's not obvious what you're doing, or sometimes you change as you go. Just because you're not now doesn't mean you might not be later. And just because you might not be a venture-backed business, just because you might not be a business for angel investors or for venture capitalists, doesn't make it a bad business. And there's lots of great businesses that just aren't a good fit for that. And sometimes it just seems that feels like the easy route. It's like, oh well, I'm just going to get somebody to give me some money and then I can go start it. But there's lots of other ways to do that. Lots of other ways people do that. And they bootstrap and they get loans and they do other things to make their businesses start. So there's other ways to do it besides venture capital. But this is kind of my take on that. So if you're trying to go down this route and you're not there yet, you don't think you hit the criteria to raise money, then the types of things I'd recommend are keep your burn as low as possible. Obviously, that means like spend as little money as possible. Keep it really simple. Defer as many costs as you can. You can do things like consulting work or other things that also help keep your costs low. So can you do things that maybe you work 10, 15 hours a week, it pays for enough of your time that you can spend your other 80 hours a week working on this. Line up employees and other people that are ready to go as soon as you have funding. So then as you start to work on that, you've got kind of the cards all stacked in your deck. And then, like I said before, add a key person to your team that makes you more fundable. So I think that's kind of my, just from all the people that I talked to, I feel like, I guess I wrote this thinking like this is what most of the people I talked to really needed to hear. So hopefully you found that helpful. I want to jump to one or two quick slides from the deck I normally use, just to give you a little bit more info. And then I'm going to ask Morgan to come up and join me up here. So one is this slide here. This is Bootstrapper Venture Capital. And I found this to be a really cool, really helpful tool somebody else showed me once. And this is meant to help you decide, should I bootstrap for my startup or should I raise money? Bootstrapping is figuring out a way to do it without raising money. And the two main axes are how capital intensive is the business, how much money does it take to get started, and how scalable is it, how big can it be? So if it's not very scalable, it can't get that big, and it's not very capital intensive, then that's a really good business to bootstrap. Because if it's not that scalable, you can't raise venture capital for it, so it's not an option. And it's not that capital intensive, so you can do it with a small amount of money. So that's a good thing to bootstrap. If it's the opposite of that, if it's very, very scalable, it can be really big, and it takes a lot of money, then usually VC is your only option. Because like it needs a really lot of money, so I don't know how else you get a lot of money other than VC. So I mean, sometimes there are other ways, but that's probably your only way, some other kind of strategic money. If it's very capital intensive, it takes a lot of money, and it's not very scalable, then it's probably just not a very good business. You should find something else. And then if it's here, this is the kind of interesting part where it kind of can go either way. If it's very, very scalable but not very capital intensive, then you ask another question. Then the question is what are the barriers to entry? How hard is it for somebody else to compete with you? If you're the first mover and that gives you a big advantage, it's actually pretty hard. You feel like, or maybe it's a niche market, you don't think other people are going to compete with you, then you might still want to bootstrap because you don't really need much money, and and you can. If it's very easy for other people to compete with you, if it's easy for other people to come into the market, that's usually a good argument for raising money because that's going to let you move faster and be more competitive against those other people. So I found that to be a pretty helpful chart. And then this is also two other things that are really helpful. So this is all the venture capitalists in town. So usually everybody wants to see that slide. This is on the deck as well on the website or online or on the videos. But showing all the different VC firms in town. We have a lot of VC firms in town. It seems like there's new ones coming frequently. And usually when I put this up here, I find that I've missed one or there's already one I need to add. Like Arena Growth is a new one that's not on here. It's raising a fund right now. You'll see most of the funds in town are what you call seed or Series A tech funds. They're investing, their kind of sweet spot is to invest a few $1 million, $1 to $3 million in tech startups as they start to go scale and grow. And then there are some other exceptions to that. The most active of those being Silverton, who we're going to hear from today with Morgan. Live Oak Venture Partners is another very active one in that space. S3 Ventures. And then some others that specialize in other places, like Sante Ventures focuses on biotech and medical devices and things like that. That's pretty different. Or Clayton Christopher, the founder of Sweet Leaf Tea, has a fund to invest in other consumer packaged goods and food products and things like that. That's a very different type of fund. Very recently, there's a small fund, True Wealth Venture Partners. They're focused on investing primarily in female-led founders as well. So some differences there, but the bulk of it, Series A tech. And these are different accelerators here in Austin. There also seem to be new options for this coming frequently. An accelerator, by this definition here, are ones that provide some kind of funding along with what they do, as well as mentorship and programming. Techstars and Capital Factory both focus on tech companies, similar to what we've been talking about, like with those VCs. And they're I think most of what you'd expect from a accelerator type program. Athena Health, which is a big healthcare company here in town, has a really interesting program. Their customers are all doctors. They've got tens of thousands of doctors, if not more, and they particularly focus on working with companies who also sell into doctors, and so they can help get them distribution out to their doctors through their platform. SKU focuses on CPG, consumer packaged goods, so think energy bars, granola bars and energy drinks and things like that. And then Unlimited USA focuses on social good companies. And I listed Y Combinator there as well. That's if I were in Austin and I were looking at accelerators outside of Austin, that's really the only generic one I would go look at. I think that YC adds a lot of value, and we've had a number of our companies go through that as well, and I think it's really helpful for an Austin company. In addition to that, when you look at accelerators, there's really kind of like two main decision criteria. It's either geographic or industry specific. And so for some people, they're geographic. They know, like, I'm in Austin, I'm not going to leave Austin, so I'm only going to look at the ones here in Austin. And other people are like, well, I don't care. It's for 3 months or 6 months. I'll go anywhere, and I'll just show me where the best thing is. So that's part of your decision. And then the other part of the decision would be industry specific. And so there are many of them in different cities that focus on different industries. And I think for an Austin company, going somewhere else that brought you very specific industry exposure could be a really worthwhile type of thing. We've had a number of companies do that as well. Like we've had a few companies participate in the Dream It Health program in Philly that got them in front of a whole bunch of medical providers and insurance providers and things like that. One of our companies right now is up at the Techstars Mobility program up in Detroit, and they're a mobility company. It gets them in front of a bunch of other mobility companies. So I think there's some good examples for that too. So I think with that, I'm gonna invite Morgan on up here, and we'll open it up to Q&A. I think we're just about right on time. And so Morgan was an entrepreneur himself out in California. Moved here. Well, I think you moved here when I met you to work for Silverton, right?
2006.
2006, and he's been really critical there in growing that firm, as it's grown a lot over that time, and now continues to do so. They've added a couple new partners recently, and I'm on a lot of boards with Morgan. We're investors together in a lot of companies. Capital Factory loves working with lots of different VCs, but just as it happens to be, we've made pretty much all of our big companies have invested with Silverton, and that's worked really well. So Sparefoot was one of our first companies, and they're a Silverton company, and Aceable that I mentioned today, and quite a few others. So they're really active here in town. They're in a lot of the best companies, and Morgan just sees tons of deals, and so really appreciate you coming in to talk to us today. And we'll open it up to Q&A. We've got about 45 minutes until 6 o'clock. And like I said at the beginning, happy to answer questions about anything you want. So you can talk about the topics that I kind of talked about today. You could briefly get up and say, like, here's where my company's at. Like, if you're looking for some advice, like, am I fundable, or like, here's my challenge I'm trying to do. You could ask about Silverton, or about like what he thinks about as a VC, how he looks at things. Or you could ask me questions about Capital Factory as well. So who wants to go first?
You put up a chart a little while ago that showed I think it was on the Are You Fundable? And I'm just wondering how
It's the crazy hot matrix for startups.
What's that?
It's the crazy hot matrix for startups.
Yeah. This one or something else?
I'm in marketing. I love 4-box models. But anyway, the venture capital, I'm imagining convertible debt resides up there. But is there any other criteria that you might help differentiate when you would go the convertible debt route versus other means?
Sure. I'm sure you could do this lots of different ways, and there could be something on this chart that said, like, am I bank financeable, or something like that, which is not something we really talked about here. And most of the companies I'm talking to are not at all bank financeable, so that's just not a choice. You talked about convertible debt. Convertible debt, for those of you who might not be familiar with it, is really the term for a structure of the investment, and when you make a normal investment, it's usually it's like you pay money and you get shares in the company, and that's like a real equity investment. But what's most common in angel investments is to go through a convertible note, which is really the simplest way of thinking about it is it's just a much shorter, simpler document that defers making some of the decisions till later. And so usually that's a good idea because one, the investors and everybody making decisions may not be as experienced, so it's a good idea to defer the decisions and maybe have work with somebody like Morgan, who is a professional investor. That's all he does every day to make those decisions. And then also, it's less overhead. It's just cheaper and faster to go do that. And so 90% of the companies raising $500,000 are doing it on a convertible note as the way to go do it. So if the question, I think, was kind of like, should I do that or not, or how do I know if I should, you should.
There's a little bit of controversy, not controversy, but just folks like, okay, what's the valuation of the company? And just seems like convertible debt might be one way to address that.
You know, it's interesting. So convertible debt, typically the convert part, it has a cap on the valuation, and it basically says, hey, that it's going to convert at a maximum of this valuation, and that's meant to protect the investors to say, hey, you're not gonna, you're gonna get at least this, a certain kind of deal. In practice, it ends up just being the same as picking a valuation. I mean, it's like, it's not that different of a decision. And in the companies that we're talking about here, in these companies raising, again, probably like $500,000, $1 million before they're really ready for a real VC to invest, the valuation's fairly arbitrary. It's not actually based on them revenues or something like that. And so valuation really just comes down to, in my experience, if you don't have any special criteria that set you off, if you just kind of meet the basic criteria of being fundable, it's typically going to be a $3 to $4 million valuation. And then other things like having a really experienced team or some more traction or other things can go up to doubling that, get you up to 6, 7, 8. If you're super rock star experience, you might get up above that, get up to 10, 12. And so that's just kind of the market that we're in here in Austin, and it's probably the last thing you need to worry about. Like it's like I would be having all your conversations. You don't even have to bring up, you're not expected to necessarily know all that ahead of time or anything like that. So you can be talking to investors, and it's okay to ask them like, well, what kind of valuation do you think is appropriate for us right now, or things like that. And the other thing is, as arbitrary or ironic as this may sound, a lot of times the amount of the valuation that you get is often a calculation of how much money you're raising, because with a real round, usually the investors are looking for a certain ownership in the company, a certain percentage, and then it kind of ends up being worked out that it's like, hey, well, we need to raise $10 million in order to start. Okay, well then you have to be worth at least $20 or $30 million, because otherwise the math just doesn't work out. So.
Got it. Thank you.
So on the other side, if the note doesn't convert, I assume you're paying some type of return. Is there a standard return that you like 12.5?
There's a coupon, which is usually like 6 to 8%. I mean,
Okay.
sometimes it can be higher, but that's kind of typical. And then there's a discount to the round. So like the cap is like the maximum valuation that you would get as an entrepreneur. The discount is like a ratchet. So if you end up raising an equity round later at a price that's below the cap, there's usually a discount. It's usually 20% that would apply.
But technically, actually, in those cases, actually, it is converting still. And
It's
so,
converting.
So it's like it's almost always going to convert.
Converting equity,
If
but
it
it's
if it
doing
doesn't
so at a
convert, it
discount.
basically usually means the company just went out of business.
And that's what I'm asking, I guess. Like, do you set up any deals where, just to incentivize investors so that they're getting something out of it, that you're personally guaranteeing, that coupon?
Oh, right, like just pure debt.
Yeah. Well.
Yeah, so
but-
the convertible part of the debt is like that you expect it to convert.
Yeah,
to
yeah,
equity.
if it doesn't.
And then if
convert.
people will do debt.
Yeah.
As a
The
return.
only
And that's
benefit to the
what
investors of the
interest
debt is, and that some investors, why some investors even prefer convertible debt, is that because of that, they have some claim on assets.
Right.
If your startup has assets. The truth of most of the startups we see is they're software companies. They have no assets. They're not worth anything. If the company goes out of business, the note ends up being worth zero. And most of the people investing have that expectation. Like, I'm either going to make 10 times my money, or I'm going to get my money back, or it's going to be worth nothing.
but still 68% on that if somebody actually did want to structure it.
No, you know, like if that's your return, like,
Yeah, it'd be
you know,
higher.
it would be higher.
Not a guarantee. No.
Yeah. I
But
guarantee it'd be
when you start talking about that, you're getting into like really honestly like almost like a whole different group of investors.
If someone
That's
wants
like
to
hard
give
money
you
lending.
money for a startup with just 6 to 8% coupon, you should
Take it.
Yeah, that's what I was surprised by that.
Yeah.
Got it.
Yeah, so like people, like when we do it, we're not looking to make money on debt. We're just
Gotcha.
deferring.
Okay, yeah.
the
It's a slightly
conversion.
different model, I know, but I was just curious, like,
Yeah.
if there's.
So
I mean,
like we
it's-
don't like, it's also done as a bridge. So like
Gotcha.
if a company needs to get a little bit further along, it's a more mature company and you're raising money from the outside and you wanna finance them to do that, but you don't wanna like set the price that the next person's gonna
Sure.
come in at, you can do it via a note as well, and that's common.
Right.
Also, those are the two most common uses, is like a seed kind of investment and then as a bridge.
I guess the ease and overhead is kind of.
Yeah, I mean, like
It's
when
not as
you
easy
when you
then.
actually do an equity round, like what the docs are more expensive.
Yeah.
I mean, not like order of magnitude more expensive, but like more expensive. And then you have to like, usually you have to structure a board and you have outstanding shareholders and you have to pick a price. And the price doesn't typically have, unless there's an anti-dilution, doesn't typically have the ratchet. So anyway, like what Josh was explaining, which is true, is like, it's basically like, if a little amount of money is coming in, like there's a pretty decent chance that like the people who are doing that might not be sophisticated and they'll probably have an equal likelihood of like fucking it up, right?
Right.
And so, and that's what you don't want, right? Because say you raise money from your Uncle Tom and he's never done a startup before and he wants to give you money at 15 million, and then you come talk to somebody else who's a professional and they're like, well, I really like what you're doing, but it's 5. Now you feel shitty because like your Uncle Tom is like
Right.
coming at this price, and then if
Sure.
you convert them, like you have to figure all that out, and so it just like,
Yeah.
don't deal with that.
I got you.
You know, just do it simpler, and then all that conversion happens.
Yeah.
And it's one of those things you can actually hurt
Automatically.
yourself by cutting yourself too good of a deal.
Right.
Like it
In
puts
fact,
you
that's the
bad
most
position.
common failure
Yeah.
Really.
mode. And you can actually screw yourself on a note too by making a cap like egregiously low, like, you know, $1 million.
Or
Right?
lower. I mean, I've seen people come in with
Yeah.
a $400,000 cap on the note, and they took $100,000, and it's like, okay, you just gave
So
away.
by the time,
you just
like-
gave away a quarter of the company.
So doesn't
you
it,
know,
why
like-
that sucks?
Goes back to that desperate thing.
Yeah.
Yeah, well, why that sucks is also like, if I'm an investor, like your Uncle Tom, like I kind of don't care how much he owns. I'm more concerned about like you and like the people that are running the company, and I want them to own as much as possible. So if it turns out that you guys get squeezed because you cut a shitty deal with your Uncle Tom, then I have to go in and fix it, because like I don't want your Uncle Tom to own 40% of the company and you to own 10, because if things get tough or whatever, you're likely to be like, oh, I don't own
Right.
enough of that anyway.
Sure.
Like, I'll see you later. And that's what or whoever doesn't want.
Yeah.
So you have to go in and fix it. So don't do that. I mean, desperate times call for desperate measures, but like, you know, in general, like if you're giving up after the Series A, if employees don't own at least 50% of the company, you fuck something up.
Right.
Yeah.
Sure. Yeah.
The blue shirt in the back of it.
This is more of a community question. In the last 6 months, can you give us the representative seed deal and kind of break it down between institutional, accelerator, and maybe angels? Show us kind of what the constituencies were. So a company that you either funded or worked with the last 6 months, can you tell us what that was funding for?
What do you call a seed deal?
Well, I mean, first money deal, first institutional money deal.
Like how much money?
I don't know the market area, tell me. So representative seed deal in San Francisco would be $2.5 million or more.
Yeah, in Austin, we like to like inflate titles, so like they call that a Series A, even though it's like it was a California seed deal. I think.
Well, it was that way. It just, the valley changed and we didn't.
Yeah, right, exactly. Yeah, their numbers went up.
I'm just
Yeah.
curious what the mix is.
I mean, there's not the mix. So in a $2.5 million deal here in town, well, you go. What's that look like? That's one of your deals.
$2 million seed deal?
$2.5 million seed deal. That's a pretty typical deal you might be in, right?
Yeah, I mean, at that point, you know, it depends on business traction. So like some seed deals, you know, they might have a couple $1 million in revenue, you know, they bootstrapped it, right? That might be in kind of the 10 to 12 pre, but like for a typical seed deal where it's like very little kind of revenue and traction, raising 2.5, it'd probably be 4 to 6
Would be the valuation.
pre.
And then
Is there any
and then what's the
preference?
makeup of how much of that's coming from VCs versus angels versus
I mean, if it's a VC deal, then, you know, typically like, I would say 50 to 80% is coming from
Has there been a deal like that in the
VC.
last 6 months in Austin?
lots.
Lots?
Yeah.
Okay.
Yeah. Yeah, so I'd say that's really common. So like, if they're leading the deal, like remember I said, like occasionally they'll put in 250K, but like that's not most common. Most commonly they want to put in, you know, $1 million, $1.5 million of the bigger chunk, and then maybe say it's a $2 million deal, like $1.5 million is coming from the VC, and like another $500,000, usually at the entrepreneur's request, they're kind of like carving off for their other investors that previously invested, or maybe some strategic people they want to bring in they think are going to add
If
value.
VCs are
in some
doing
way.
it, they're probably doing at least 50% of
Yeah.
the round.
Now you might be doing $1.5 million round, or that'd be like a big Austin seed round or a big angel round or whatever. And if a VC is not participating, then the makeup's going to look completely different, and it's going to be like, you know, it might be CTAN's taking half of it, and then half is a bunch of other angels, or you know, 2 or 3 angels in at 100, 200K each, and then a whole bunch at 25K each.
What are the probability that check sizes are above $100,000 in the angel community in Austin?
There's like a huge angel community of people that will write $25,000 checks, and there's like 25 people that'll write a couple $100,000 checks. I don't know if that 25 is exactly the right number, but it's just like, I mean,
Yeah, that's about right.
it's a much smaller number, you know, like, and that list is obviously like really protected, and everybody wants to go talk to them, and they don't want to, they're, you know, they're really busy, so those people are hard to go talk to. So yeah, it's like really easy to get a 25K check. Pretty hard to get a like 250K check. That's like I worked for that guy or girl, you know, like, and they know me really well, and like they're seeding my next thing, or it's strategic in some way to something they're doing. I don't know.
So in our situation, so I've bootstrapped the company $1 million. We're work with a lot of
In revenue.
In revenue, right? Work with a lot of global brands, big name companies, and we're looking for between $1.5 million and $2 million. Where do we start with somebody like you? Do we go get some angels first, and then where does that?
Yeah, I mean, like our average investment size, our initial average investment size is about $1.5 million. So, and we go down at, like Josh said, on an exception basis, like 250, 300K. So you certainly could come talk to us. You know, in my experience in this town, like, you know, raising $1.5 million angel round is possible, but not
That's a big angel
super
round.
straightforward.
Yeah.
So if that's the amount that you want, like, I would talk to VCs also.
Should I ignore all the efforts on the angel side, and focus strictly on the VCs?
No,
first,
I mean, because it's,
or-
you know,
Or is it
I
like
don't
a
think it can
piggyback
hurt
where
you,
you'll
right?
pick up a few on the way?
Yeah, I mean, I would do both in parallel. I wouldn't like just exclusively focus on one or the other, because the thing with angels too is like they can be super value added in the sense that they've run a business in the area, or they have contacts with customers, or, you know, we're just people, they're just people. We've, you know, generally had successful track records, so like they can be as helpful as we can. So I wouldn't say ignore them. You know, I would probably start with, if it's just money, and like, oh, I'm gonna go talk to a bunch of doctors and I'm running a software company, like I probably wouldn't do that right away.
Yeah. Well, and also it's easier to just get one big check from VC.
Unless it's a healthcare.
That's like it's just a lot easier for you, right? So if you can, yeah, go do that, you know. But like usually you got to go do other things too. I would say the other question I'd ask as you think about that is like, what happens next? Like, so a lot of times in that situation might be like, I bootstrapped this to $1 million in revenue. I think I need to raise another $1 million or $2 million, and I'm done. Like I'm not raising more money after that. And in other cases it would be like, we're about to go blow this out. We're gonna raise $1 million or $2 million, and the next step is we're gonna go raise $5 or $10 million, and then we're gonna go, you know, like, and I think they could probably help you in either way. If you're doing the latter that I just said, like we're gonna raise this and then we're gonna go raise more, then you definitely want to have a VC behind
Yeah,
you, because they're
I think
gonna
that's fair.
help you get down that path, and they're gonna participate in that. The other thing I'd say is the deal you described sounded like a CTAN deal too. Like
Yeah.
CTAN has they have like a pretty narrow band actually of what they look for, and like that fits it exactly. Like you bootstrapped to $2 million in revenue, like it's totally de-risked, it's a real business, they're not gonna lose their money, you know, like and particularly in the case they like, whereas they're gonna like, I don't want to speak for them, but most VCs, if you said I only need another $2 million and then I'm done, like usually that's actually not that attractive to them, that profile of a business. They usually, the types of business they want are ones they're gonna keep scaling.
Yeah,
out.
it's more the case of like how big.
Whereas C10's gonna like that. They're
How
gonna be
big
like,
are you trying to build it, right? Like if you're trying to build it to like a $25 million outcome, which is a perfectly fine great outcome, like I would probably stick with the angel side. I mean, that would be a decent return for us too, but like, you know, we're managing $150 million and trying to return $500 million, and so,
Right.
you know, if we own
So
20%
20%
of your
revenue
business,
or in valuation?
in value, in capital back to us.
Okay. Gotcha.
Money they put out, money they put
Yeah,
out.
so like,
So
you
$100
know,
million exit, that's.
so say we own 20% of it, right, or 25% of it, that's $25 million. We need a reasonable amount of those, or obviously some bigger ones to like get where we're going, but like to sell a company that we own 20% of or 25% of for $20 million, you know, it's like $4 or $5 million. Like that's
He's trying to
a
get
great
to 500,
outcome,
it
but
just
like
doesn't-
I'm trying to get to
doesn't move the
500,
needle,
right? Like that, you know.
And the other side too, like just back to C10, C10 will look at that. If the answer was we're gonna raise $2 million and then not raise more, C10 would look at it and be like, good, because I don't want VCs to come in and dilute us. Like again, there's like these weird dynamics of like whether you're gonna raise more money probably has a big question to that.
The other thing I was saying about notes is, you know, to your point about talking to angel investors, the thing about notes is you can kind of do rolling closes with them. So like, you know, say you had 300K of your $1.5 million lined up, you can just close on it, take that money, start doing shit, right? And then you don't have to have the whole $1.5 million spoken for. And so
I talked about some of the trade-offs to that early on. I said
Yeah.
that happens a really lot, and I've certainly
Yeah.
encouraged that. But then I was also saying how at some level it's better if you can just get a whole bunch of money at once, so you actually know how much money you have, and you can go do it.
Yeah.
But
Yeah, I
those
mean,
are the
there's
two
trade-offs.
trade-offs. You know,
Yeah.
it's like sometimes it's like I need money now.
certainly if
I
you
close
can,
it now.
better to have it.
Yeah.
So, you were talking about the daily active users and monthly active users. What are the numbers?
You were
or
reading. I didn't even
ratios
say that, but
that you, yeah, we're reading it. That you guys look for in a company that it depends on that.
consumer metrics. You got anything on that?
Monthly active users?
Monthly
Yeah.
or daily, but whatever ratio you guys use.
Yeah, I mean, you know, it's obviously more complicated than that in terms of like how directly monetizable, like who you're targeting and like how
So
you
let's say
monetize.
Words with Your Friends
Words with Friends.
was a game. You know, if it's a game,
Sure.
you play it. Had a lot of monthly users.
Yeah.
So, or daily users. So what I guess have you guys invested into something like that currently, or?
You know, the consumer companies we've had tend to be kind of more directly, if it's virtual currency or something like that, like.
Well, it could be
Well, they're
monetized.
investors in
There
Favor.
could be
Yeah, so
example.
Favor, Sparefoot, Aceable, the Zebra are all like consumer companies we were invested in. They're all selling.
It's not a.
They're all
usage-based.
selling a product. You know, virtual goods is the same thing. It's a freaking product. It's just virtual.
Yeah, this would just
So-
literally be a game
in this
that
case, you know,
purchase.
from the stuff that I'm seeing, the first point I was making is it's a vocabulary, it's how you talk about it. So I just know right away, if you're not saying those words, if that's not how you're measuring yourself, then I know you're not even like, you just don't even have the right tools, like the right rulers. You're not thinking about it right. It's not so much exactly what the number is do you know how to think about the business? And I'm telling you, most of the people I see don't. They just like aren't even measuring the right things, and they don't even know what success looks like or what they should be measuring. The second part of it is so then most companies we're dealing with are still really early. So like they don't have a ton of that traction. So one, I want to know you're measuring the right things, and then personally, like what I'm looking for at the very earliest stages is really repeat usage.
Okay.
Now that's gonna be
So
measured
retention.
different ways for different products, but what I'm looking for is like somebody actually freaking likes this, and like cares about it. They didn't just download it. They didn't just use it once. Like my first question I ask people, and it's like such a simplistic question. I'm not saying this is perfect or anything. It's just for me. I'm just like, how many people have used your product 3 times? Just give me a number, the absolute number of how many people have used it 3 times. Because to me, I'm like, well, the first time they were just trying it out. The second time, like maybe. The third time, you must have done something right, you know, like to get them to go use it a third time, right? And I'm looking for like some kind of repeat usage. And then another stat I heard, like with one of the companies that we work with here at Capital Factories, they came in and said, hey, look, you know, of all the users we have, a quarter of them have logged in the past week. I was like, all right, well, that's pretty good. That's like, you know, like a bunch of people, you know, and there was thousands of users, you know, like, so it's going to be different for each business. But what I'm looking for, for me at the early stages, is not that you got a lot of people to use it, because it's that the people who used it a lot.
Yeah.
And are really into it. Because if you can show that you've got something people want to use a lot, then I believe we can get it in front of more people and get more people to use it.
Yeah.
That's not the hard part. The hard part's getting something that people actually want to use a lot.
If it's a game and people aren't using it like daily or weekly, like.
No, it would be a daily game.
Yeah.
Well, no,
But
that's
that's
what I'm
what I'm
saying.
saying. Yeah.
Engagement wise, right? Like they're not really a user unless they're using it at least weekly.
Yeah.
Yeah.
Right? And then like the rule of thumb is like, you know, at an early stage, if you're not doubling like every 60 days, like it's not, from a
The thumb
venture
of it.
standpoint, it's not that exciting. So like
So
where we would
like
get
doubling
interested in
every
this
60 days?
every 60 days. And so like what would get interesting to us is like tens of thousands of people, not hundreds, but tens of thousands of people doubling every 60 days.
Mhm. Do you have a specific criteria for ed tech? I mean, if it's not, I mean, I guess everything's volume based, but, you know, in an educational environment where, you know, I guess just the barriers to your consumer getting it.
But
is-
ed techs, I mean, ed techs is that's not that simple. Ed tech, are you selling to universities? Are you selling directly to consumer?
Yeah,
Are you
well, so
selling
like,
to
let's
teachers?
say it's on the secondary, on the secondary
Secondary
level, either secondary or on the, university level.
You're selling to universities?
Yeah, 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 so-
It's enterprise software. It's not, it's just like any other enterprise software.
Okay, so you're just
Those are
basically,
just-
so if you have one contract in place, you would,
That's like having one big contract in place.
Okay.
Yeah, I mean,
It's a
ed
big
tech, I
company.
mean, people tend to be laggard, I mean, the nuances are, people tend to be laggards to adopt, and then they tend to be like very reference oriented, right, like.
from university to university.
Yeah, from university to university, and then, and the churn rate tends to be pretty low. So like, it's hard to get them to buy new shit because they don't,
Sure.
they're kind of risk averse, they're on the laggard end of the scale.
Yeah.
And then, but once they buy it, they don't tend to like go hunt for new versions of the same shit very
Yeah.
often,
Is
basically,
the
yeah.
black shirt in the back and then the blue shirt in the back. I know you've been looking, raise your hand.
I've got 3 short questions I'll be quick with. The co-working spaces, Joshua, I think you probably know a lot about this. It seems like there's a dozen co-working spaces in town.
There's only one you need to know about though.
And the commonality is they all seem to be doing very well. They're fully booked. So many of them have a waiting list to get in. If you look at the dollars per square foot that you get, it's about 4 times the retail rate, but then it's a smaller chunk.
This was the
It
quick
might
question.
Be affordable. Is being in a co-working space a plus for a startup or not relative?
Well, okay. Look, I mean, I'm biased. I run a co-working space. I think it's a plus. I think it's gonna be a different plus depending on different places you go. The reason you should work here is not because you need a desk. It's not because you need square footage, and it's not because you want to work downtown. It's just because of the people you're gonna meet here. And that's how, if I were you, if I were evaluating co-working spaces versus the cheapest possible place I could work, which is probably at home for free or at a coffee shop or somewhere else, it should be, what am I gonna get out of it? And you should work here because you're gonna meet someone who's gonna change your life. Because you're gonna meet your co-founder, you're gonna meet your first investor, you're gonna introduce this, one of your first customers, something that's gonna like completely make anything you paid for rent, like not just completely insignificant and not worth it. And if you're not gonna do that, then I would go work from home for free.
Okay, so it's the networking you can't get at home.
Yeah.
I've recently met with 2 different.
We got, but we have a lot of people questions, so what, you said you had 3, which other 2?
I recently met with 2 different angel groups that were so harsh. Said, okay, you're 0 revenue, you have 0 valuation, never mind the 2 years of your own sweat equity and $400,000 of your own money. We don't know how to work that in. So,
Sounds like a pretty common response.
yeah, so, I understood your earlier comment that you transcend this 0 revenue by building the team versus, a results valuation, but then, so many times when I've tried to bring in other co-founders and team members that have, a success, and I've had 2 exits of my own, these guys have big egos, and it's hard to find a match with my own ego of how much do they get in the company, when does their salary kick in, usually from day 1, to associate their name with the deal. That's easier said than done.
Oh, it's really hard.
To
it's
find
really
that
hard.
match of co-founders to transcend.
Yeah, the best co-founder is somebody you've already known for 20 years.
And the
Doesn't
third
help you
last
very much,
question,
right?
I do have my own real estate. I was able to convert a lease into a purchase option on a little property on South Congress, and it's already gone up 60% in value just in less than 3 years. This is my nest egg of my retirement, if you will. Should I make that real estate where the business exists today an element of the deal, or keep the real estate isolated under my own person and just
If you
lease
need
back
it
to
to, if you
myself?
need it to live on, keep it isolated.
Okay, so just lease back from myself.
You should lease it back from yourself.
Yeah. Don't risk what you need on your startup.
So you sort of answered this before, we got a small cybersecurity startup, we're building an MVP right now. And so my first part of the question is outside accelerators, where can we meet VCs outside of accelerators? Because the team has their own day job. And so the second part of the question is if we're not going to the standard accelerator where we spend a month or so just working on the startup, how do we, or are VCs open to saying, okay, here's a chunk of money, carve this out so you can leave your full-time job?
Yeah. So a couple things. One, the assumption that Accelerator is I'm doing Accelerator all the time is probably not correct. There are some like that, there are some aren't, so I would separate that part. But the part of like, I'm not working on this all the time, like nobody's gonna give you any money until you're working on it all the time. Like that's just like definitely not a VC. And they're like probably not that interested in talking to you. I mean, obviously if you're super high potential, they might invest their time in meeting people, they do networking and other things like that, but like no, you need to work on it. You need to be working on it full time. It's a hard chicken and egg problem. One thing this is not an announcement, but we're going to be launching a program this year, probably later this month, that's targeted on getting you kind of like quit your job money, like the first 25. And that's going to be, but you have to be like committed to like I'm quitting my job right now to go do it. And like nobody's going to give you any money if it's not I'm quitting my job right now to go do it. You want to add anything to that?
I like it. I like quit your job with it.
Yeah.
Yeah, we're coming up on about a year, I guess, of equity crowdfunding being allowed for non-accredited investors. How has that changed things, and do you recommend or not recommend people go that route?
Sure. It hasn't changed things that much. I mean, there was a lot of speculation initially that like venture capital as an asset class was gonna like be dramatically disrupted by the fact that everyone was just gonna kind of get into it. I guess what I'd say about it is like it's really hard and like takes a long time, and like most people just they're not financially geared to do that, and they don't. Most people lose a lot of money before they make money, and so like I don't perceive that to have happened. As far as whether it's a good route, I think that there are some products that are very well suited to like crowdfunding. So if it's like an actual consumer good that it's a cooler or a mug or like something that's kind of novel that people can like you can use Kickstarter
or
something.
games have done really
or
well that way.
games,
Just
where
that they
people
really
are
want the
passionate
game.
about a particular kind of genre or like a particular idea of what you're going to build. Like that stuff works really well. Like crowdfunding for like a enterprise software startup is more challenging.
Yeah, we just don't see it. I mean, I'd say really slow to take off. In the companies who get crowdfunded are companies who cannot get funded other ways. That's why it doesn't.
Which is fine. I mean,
yeah, it's a good thing for that reason. But that's why it doesn't hit them at all. Like if you're raising money through crowdfunding, VCs wouldn't have given you money. Almost exclusively. That's just what we see happening today. I'm not saying it'll always be like that. I think it'll probably change, over time and get more accessible. But right now, it's because you're not getting funded any other way.
So is it a safe assumption that companies that are crowdfunding went to venture capital, or
And got told no.
Okay. Yeah.
Almost, probably. And unfortunately,
It
I mean,
depends on where you are, right? Like
Yeah.
if you're in Akron, Ohio, maybe you didn't because there aren't any VCs there. But
a lot
if
of
you're in
it-
Austin or San Francisco, right? Like you probably tried something else.
And a lot of investors are going to look at that and see it as a risk. They're going to say, wow, now your cap table's complicated. And there's other investors, and now there's like 1,000 people who could sue me, like for being part of this deal, right? And I don't know. There's just not a lot of history. So again, I think crowdfunding is awesome. I'm glad we have it. I think it's going to enable lots of businesses to happen that wouldn't happen otherwise. I think it'll only get better. It's not the answer for these companies that we're talking about, like.
If the company has a straight debt source of funding prior to raising a standard seed round, is that perceived as negative or positive?
A straight what source of funding?
Just say
straight
a
debt.
sizable
Oh, yeah.
bank loan, is that considered possible positive or negative?
Yeah, so you have to look at like most debt has to be repaid at some point, and so.
Let's say it's just be a loan, so it's multi-year, long-term.
Yeah, so like most businesses like that you're investing in the early stage take like 7 years to like come to fruition. And so as an early stage company, the fact that isn't gonna come into play before you're debt is due is unlikely, and most debt is due like in a year or less, you know, for early stage companies, and so it's not negative. I mean, you kind of got to do what you have to do, but like if I were to do it, I'd look at it as, you know, like it's unlikely that business is going to be cash flow positive and can service its own debt in the time frame that it needs to. So like I'm basically taking on that liability, and like I'm either comfortable with it or I'm not. Like I would just look at it as, you know, hey, we're going to finance this with somebody, you know, do I think we can build this company up to raise money at a higher price from someone else later and use that money to like pay off the debt and have it be less dilutive, but like something has to be done about it. So, and it's really rare. Like I think I can probably count on one hand in the last 15 years where I've like looked at a company that has like a non-convertible.
Yeah. They might have an
debt
SB, they might have
structure.
like a Silicon Valley Bank line of credit, but not a debt.
Yeah, sure.
Like,
And I don't really count that.
Yeah,
Or
you
maybe
won't-
it's a
you won't
loan
get
to a
that till it
founder,
goes
and
along.
it's kind of like I don't
Yeah.
count that either because I'm just going to tell you to not pay yourself.
So slightly different just perspective on it. I think I agree it's super rare because just we mostly work with software and hardware companies, and most of them would never qualify for any kind of bank financing or SBA loan. But like if it was an SBA loan, which actually like you have a long time to pay back and everything else, it'd be super rare, but I'd probably see that as a positive thing because
Yeah.
chances are whatever you did to qualify for the SBA loan is it
Yeah.
looks good. That like the net, it's not the loan that makes you look good, but if you qualified for an SBA loan, like you probably have real revenues and assets and like other things like that. Or you personally guaranteed it. I mean, you know, like that as well too. So we have time for a couple more questions.
Yeah, are investors influenced by the price model for the product? So for example, we're a prem-based product, and the standard in the past for prem was you charge a license
Prem
fee
is
plus-
on-premise?
Yeah, it's premise-based, you charge a license fee and 20% maintenance, but it seems like the industry is moving more towards a subscription model. Does
Yeah,
that
a lot.
influence your chance of investing? Like if we say we're doing
Yeah, I mean,
license plus
valuation, like
maintenance,
valuation, like multiples and stuff are less
Yeah.
for traditional license-based
Yeah.
companies, mainly because, you know, the predictability of revenue is less
Yeah.
because you have to, you know, you're only getting 20% off on a recurring.
Yeah.
I mean, you know that.
Yeah, yeah.
Take you through the
Yeah.
nuances of
Yeah,
business.
so if you're on a subscription, even if it's premise-based, it's more positive.
Yeah, and then the other thing is like, you know, the big software companies, the big enterprise software companies, they're trying to get more SaaS and less
Yeah, yeah.
on-prem.
Yeah.
And so, you know, for us as a venture firm to do an on-prem deal, knowing that like, if these guys are gonna buy anything, they're probably not gonna buy another on-prem I mean, this, to
Yeah.
some extent, everything's a generalization, but
Yeah,
like,
yeah.
generally it would make things harder. A lot of people that started with on-prem are kind of going through transitions. Transitions are freaking capital intensive because, you know, usually license is paid up front and it's a higher value because it's a perpetual license than you would get from SaaS. So you almost have to like take it in the shorts to convert because you're only getting half or a third of the value, but yes, you have an expense structure that's based on a license model. And so like, as an investor, having been through that transition with several companies, I'm kind of like, okay, well, how expensive capital wise, you know, one, do they want to do it? It's probably a good idea. And two, how expensive is that going to be? And so it has some considerations to it.
And I would get this back to the market stuff I was talking about at the beginning. When I look at that, to me, this is actually still, it's even just market. Like, and I'm talking big market now, because I'm talking market of SaaS, which is a freaking huge market, if you want to call that a market. But like, SaaS is a big growing market, and has been for a long time. And on-premise is a shrinking market. So I don't want to invest in very carefully in a shrinking market. Another thing, like he said, is like what kind of thing deals we see. Like nobody is pitching me anything on-prem. Like my first business was an on-prem business that went SaaS. I went through that transition, so I'm very familiar with it. But nobody pitches it. Anybody that has anything on-prem, they pitch it as a SaaS business.
Right.
They sell it as a SaaS business. It's a box you buy and it has a SaaS subscription attached to it, and they rework all their financials to make themselves look like a SaaS business because they know that that's what everybody wants to see and that's how they're going to get value.
So.
Sorry, I want to make sure we're bouncing. Anybody has not asked a question yet?
Back to your initial blog post, for that 500K for a 1-year runway, is there a typical size co-founding team you would expect that to occupy? 2, 3, 4 people, and then whatever typical size of people you would expect How much do you expect them to pay themselves for that 1 year to live?
Yeah.
Or it's,
When we're talking about $500,000 to $1 million, it's a small team, like probably 5 to 10 people, and they're getting paid as little as they can possibly, like as much to like pay their bills, but like probably like a few $1,000s a month each. Like they're not getting a lot of money. They're getting $30,000, $60,000 a year. You know, like.
And I think that's true, and like it depends on your stage of life too, right? Like if you're 45 and have 3 kids, you know, you're probably not able to pay unless you saved a lot of money, right? Like you're not able to pay yourself a couple $1,000s a year, but it's kind of like your lowest survivable wage, right? Because as an investor, like, yeah, I want more money in the company, but I also don't want you like stressing out about like making your utilities payment. I'd rather have you worried about like building a multi-billion-dollar company.
But I would also, and I know Morgan missed a little bit of the beginning part on the. I would draw the demarc between the 500K. When you're raising 500K from angels, you're probably not paying yourself a full salary, and you're gonna have to find some way to make it work and do other stuff. When you get him to give you money, you're getting a couple $1 million, and now that's like the point where you get a raise, and you're probably still not making market, but you're making like enough, you know, like more. And for the same reason he said, like he's like, I'm not gonna put this money in if you're not able to pay yourself enough to like watch, you know, to take care of your stuff, because I need you worried about the business, not worried about paying your mortgage, right? Like, and no investor is gonna want you to like not be able to survive. But the other flip side is just like, if you have 3 people making 150 grand, that 500 grand ain't gonna last very long, you know?
And
Like,
I mean, what I would say is like, at seed, it's kind of that lowest survivable wage. And then at Series A, you know, it's probably 50
Below
to
market.
75% of market. And then by Series B, you're kind of like at market to slightly below market is kind of like what we try to do. So.
that sounds right to me. And it kind of also goes inside with like, at Series B, you're typically probably crossing the cusp of at least maybe profitability, but like, you know, like making a lot, and then it's like, okay, we can pay ourselves, you know, we're actually making money now, we can pay ourselves.
And it's not just what investors tell you. I mean, like, if you're like a smart entrepreneur, right, like you want to own as much of the company as possible, right? And so like for every $1 that you spend in cash on yourself, that's $1 you don't have to spend elsewhere that actually comes out of your, I mean, it's giving you cash, but you're paying equity for it, right? So if you think that equity is worth 20 times what you think what you're getting in a Series A valuation, like why would you give that up to make another $1 of current comp if you didn't have to live, right? So, and if you're not thinking that way, I'm kind of like, how much do you really believe in this idea, or are you just telling me that it's going to be huge, or are you actually like acting like it's going to be huge? So,
Time for like 2 or 3 more. So, what do you got?
So, the founding members don't have to be accredited, right?
Investors?
Yeah.
Remember.
Huh?
Founders or investors?
employees, like company employees
No, founding members,
of a company.
founding investors,
Investors or entrepreneurs?
investors.
I don't know what a founding investor is.
Well,
There's founders who are entrepreneurs, and there's investors.
investors.
Okay, and
Yes.
all investors you want to be accredited.
So if I have anybody that invested in our company and they're not accredited, what do I need to do?
Buy them out.
Buy them out?
I mean, first choice. I don't know what you think.
Yeah, you know, like that'd be a good question for an attorney. Like, I don't know what liability you have. Usually when people invest, they sign a document where they kind of proclaim like, I'm an accredited investor. And if they lie, like that's kind of on them. Like you don't have to like do a forensic audit of their finances to make sure that they're telling the truth. And so you should have them sign off saying like, I'm accredited, because that's a requirement for you taking money from them. So if they're not, like, and you know it, there's probably, you should talk to an attorney or, try to, obviously if you can buy them out, great. But I don't know what liability you have for knowing that and still accepting.
Yeah, I mean, and at some level, I mean, I gave you the simple, easy answer. Like I said, the easy answer is like, what you want to do is like give them their money back and like buy them out and have some, have an accredited investor. If it's the biggest risk that I understand is that they could sue you. So if it's your mom, you might not be worried about that. But because they're accredited, they're not accredited investors, they can claim that they didn't understand what they were investing in. And as a part of being an accredited investor, what that says is that you're
and where that comes from is right, like in public companies, like there's the SEC, and like you're required to report a bunch of financials and stuff, right? And so like, you know, there's information out there where like anybody's supposed to be able to interpret that and like make a judgment, but like in the private market, like I'm not required to like give you anything as an entrepreneur. You're making your own decision, and so it's to keep like con artists from swindling like your grandmother out of.
Right.
I mean, that's the purpose of it. So.
Yeah. Glasses in back. Blue shirt. You got a question or no? You good? One more. Who? Anybody? You have anybody not asked a question? Do you ask a question? You asked a question?
I haven't yet.
Okay, both of you guys.
So, in a B2B SaaS company, how would you typically arrive to evaluation throughout the seed, Series A, Series B rounds? And then, can you give an example of a typical company in that space that you've worked with real numbers?
Yeah, so valuations, I mean, it's a little bit of a art initially rather than a science, and then it kind of gets more scientific later. So like I would say the average like seed valuations in Austin are like $3 to $4 million pre. The average Series A is kind of $6 to $8 million pre, and the average Series B is, I don't know, probably 18 to 25.
What have you seen in other markets?
The Valley, it just depends, right? Because the rounds tend to be bigger too, to Josh's point. But yeah, I mean, the most expensive market is probably the Bay Area, and it varies. Like at the most heated part of the market, they would probably double what I just described and come down. We kind of, everybody oscillates, like our amplitude is muted compared to their amplitude. I'm just gonna be dorky about it, but anyway, and then you real example. So yeah, I mean, you know, I guess WP Engine, like the first round was like 4, the second round was like 12 or 13, and the third round was like 65, 70. There's a lot, I mean, I could give you 30.
There's
examples,
lots of
but-
details in there, but yeah.
Yeah, it's a longer story.
Yeah. But that's a huge success story. I mean, that's one of the most successful companies I've ever worked with or been connected to. And that's like everything worked right. Like they
How
built the
long
right
was
thing
that?
first,
The
and everybody
5 years?
wanted it, and like like it was like.
It was probably 3 years. I mean, not from the inception of the company, but like
But
from
seed
our
raise.
involvement. And then they raised a small angel round prior to that, which I
It was 100 grand from
conveniently
Kip.
omitted. Yeah, it's not a grant from Kip. So, you have one?
Yeah, so if you have 2 full-time co-founders that have been bootstrapping, but then one has to take a job because they've kind of run out of cash, they can't bootstrap anymore, how do investors look at that, and how do you kind of work with investors to make them comfortable with that?
I think it's what you want to be able to say is like, oh well, he took a job because we're paying the bills, but as soon as you make this investment, he's quitting his job and coming back full time.
Okay, gotcha.
And if that was true and that was the case, then I'm probably then it's kind of like, okay, you're kind of in a holding pattern. This is gonna fix that.
Okay.
But if this isn't gonna fix that, then I don't want to put the money in it until you're gonna both be working on it full time.
Gotcha.
Yeah, it's
Most
more
likely.
just like who's still there that can move the ball forward, and if someone's not there that's required to move the ball forward, stipulation needs to be true. If it's like, oh, that guy went back to work, but we found a guy that's twice as good, like, who gives a shit?
Yeah, okay.
Yeah.
You're really desperate. Go for it.
Got it, really fast. So you said the process can take 6 to 8 months. How do you guys prefer entrepreneurs kind of building that relationship with you and staying up to date and making sure that you guys know what the hell's going on?
I mean, it's not so much that like it's 6 to 8 months of like you sending us updates. I mean, there is something to be said for like developing relationships and like like getting to know people over time. But it's just like if you just think of it like if say you want me to give you whatever is a significant amount of money to me, whether it's $10,000 or $25,000 or $500,000, I need to have a comfort level with you. It's not like we're gonna have one meeting, sit down. I mean, this does happen occasionally, but it's very unusual. We're gonna have one meeting, sit down, and be like, "That is awesome! I'm pulling out my checkbook right now and writing you a $500,000 check." Right? Like, I want to get to know you, right? And so I'm the only one in town that does that. And that's starting next month. And so
free beer tomorrow.
it takes time to get to know people. That's just all it is, like, and so typically it's like we're gonna meet, get together, and like, if you wanna meet, it probably takes us 2 weeks to schedule the freaking meeting, like, and then like, so that's 2 weeks from now, and then we have a meeting, we sit down, like, that was great, you should talk to this person, and this person, and this person, and then I want you to go talk to them, and then come back to me 2 weeks later, and be like, hey, this is what I did. I talked to these people. I did this. I did that. It's like you can create urgency if like everybody wants to invest in your deal, and you can be like, hey, I got this deal. It's going to close in like 3 days. Are you in? Like if it's real, you can make that happen. But like usually it's not like that. Usually it takes time. And it takes time for me to get to know you, and then it's kind of like there's a snowball effect, right? It's getting that. It's like you're dancing with a whole bunch of people doing that until when it works, somebody says yes. Somebody's like, yeah, I'm in, and then you build on that, right? Then you go to the next person. Well, hey, Morgan, Kip's in. He said he's in. Are you in? Like you start playing them all off each other like that to try to build it up, and that is how it happens, So, all right, great. I want to cut us off on time. Certainly respect of Morgan. Really appreciate you coming in. Thank you, Morgan. We, as I said, we do this talk once a month. So, and we have, while Morgan is the best VC in town, we do have other VCs come up and do this as well. And so if you came back next month, there'd be a different VC up here that you could meet or could talk to. And then Areej in the back is one of our, helps run our Accelerator program. So if you have questions about Capital Factory, she's a great person to talk to. You probably saw Liz getting the tour as well. So she's another great person to talk to. And we are looking for venture associates. So if you know anybody that is super passionate about startups and wants to get paid to meet every startup in Austin, that's who we're looking for, is some people like that, and we'd love to meet them too. So, thanks. I mean, there's people who blog about consumer startups. I don't know one off the top of my head. Okay. But like, you want to be like reading the blogs about people who are running consumer startups and doing consumer metrics and consumer marketing.
Okay.
And honestly, if I just went to Google and just typed in like, so there's like DAU and MAU, daily active user, and monthly active user, I would like type in DAU, MAU, and just like look through those pages. Like, like that's people writing about it and talking about it.
I'm gonna write that down.
DAU, daily active user, monthly active user. Those are just two of the metrics. There's a lot of other ones. But like anybody talking about daily active users and monthly active users, we're gonna talk about that.
I'm a old broken down Honda guy, so I'm getting caught up to this.
Cool.
We have a real cool.
Do you know Craig Cummings?
I did not. We drove up here today from the show.
Oh wow, that's awesome.
Okay, so daily active users.
Daily active users, monthly active users, and then I'll take that other name to look at.
Too many years of helicopter. And monthly.
And then the other name to write down is Craig Cummings.
Just wanted to say thanks for being here. Appreciate it. It's fun.
Cummings, C-U-M-M?
Yeah. And he's a veteran entrepreneur who's now has a new VC fund for investing in veteran entrepreneurs.
Okay. All right, excellent. I appreciate you.
Nice to meet you. Thanks for coming. All right.
Josh,
Hey.
great discussion. Actually, it was the last time we pulled me up. So I come out of genomics and biotech. I worked for Craig Baer back 20 years ago. Was recently was running marketing for Central Healthcare, which is based in Austin. Left to do a startup. We're kind of late on that seed round. We've already got a couple of investors. And but anyway, I would love to. If that's something more on the, I know you guys are a little bit, seems like you're a little more IT in that area. I did notice Wendy, I caught her name, but if you'd like to discuss that more, I'd love to talk about it with you with my background in genomics and biology.
Yeah, so Wendy is definitely one of the first people who shares our health practice. So she'd be a great person who would understand more of it and be able to kind of like help us with it. The other person in town, do you know Spencer Wells?
No.
You need to know Spencer. If you're doing anything in genomics here in Austin, you know Spencer Wells. He's the founder of, I always pronounce it wrong, Incitome or Incitomy or which is
Trent
one.
Benson is on our, was one of our advisors. He spun out of Lumex. But anyway.
And then he also founded a veterinary genomics company.
And you have ideas?
Just wanted to thank you.
Okay, thanks. So he's got two genomics. He first mapped the genome for National Geographic. He was the first one to map it. So he's here in Austin.
The genographic project, yeah.
And so he's somebody should come.
That's great.
Yeah.
Thank you.
Thanks. Very cool.
See you.
Yeah, absolutely. Yeah, so I thought with Morgan, I've got a couple other emails already. Anybody off the top of your head would be a better fit for us. And we're also applying for CTN.
Getting back to that other question of like, what do you think happens next? Like, you totally sound like CTN. Like, CTN's not so my first choice of where I would go. Like,
I've heard mixed things.
I would take money from Morgan in a second first, or from other places. But certainly it's good to have options.
Yeah, I figured because of the process.
And this sounds like something that would like, again, for all those reasons, you're bootstrapped to profitability or to scale. You probably don't need a ton more money. You know, like they're like all those things.
So the fact that I do expect to do a second round.
That won't scare them off, but like if you could, but they would like him, like, but I might not need to. They're just that like I don't have to, you know, like. But this was a good start. I mean, I don't know. You know, we definitely should sit down and talk about it too, and specifically. It's not. It doesn't end up usually being like, oh, here's the 5 people you're gonna talk to. It's usually like you gotta fucking work it. Like, give you like point in a direction, but like honestly, it's hard to know what resonates with you. You know, like I can sometimes be like, well, that VC won't like that. You know, like, but
yeah, I don't know what rest anywhere. Like I said, I think it took $2 million to get it done. Yeah. I don't want to. CTAN seems like they were
$2 million in Austin. It's a VC deal. I mean, CTAN could do that. You know, so man, it's gonna take you fucking year, and it's painful. Like, you know, like
we're starting the process, but like I said, I don't want to rely on it at all. Say I start with CTAN and then I connect with say Morgan does. Would CTAN still participate, or is that against that?
I mean, you don't, once you have Morgan in, you don't want CTAN to participate. Now they're gonna. Once they decide their plans, they usually want as much of it as they can get. And now you're negotiating with them to like, well, can I have at least $300K for my other investors, for these other people I want to bring in, you know, like things like that.
So we're starting the process, but really focus on that.
Yeah, again, because it's slow. But I wouldn't even talk about CTAN with VCs. Like, don't be like, well, I'm talking CTAN too. Like, I would ignore them, you know, like, and just be doing that for their benefit.
Very good. I'll let you run. What's the best way to connect? Meet up sometime.
You know, email's still good, and we'll just get something like calendar for this week.
Sounds good. Awesome. Thanks again. Appreciate it.
Hey Josh, I'm here in Fontaine, and I do payments and things like that here tonight. So I came tonight, so I have a ton of 40 fintech startup clients, some of whom are considering moving here. So we're looking for accelerators. So a ton of great information. We'll send them to the website, we'll walk through the process. But they see some mentors. Because for a long time, sometimes every time we talk to a fintech company, they've screwed up monumentally and break a right? So we come in and we do funding, we do private design, compliance design, we did on-stage product design. Just finished 2-year project in the library for a ton of big financial institutions. So if you guys can use us as subject matter experts to help talk to the accelerator participants or even your members who are playing in a regulated space, we do fintech, healthcare.
It's not something that there's demand for right now. I don't see. Like we have generally has only have kind of legal resources that we see, other than people wanting stuff for free.
No, I get it.
Everybody wants stuff for free. But the types of things that we see that works well with kind of the mentor setup is typically IP, because people want to come and be like, should I have a patent? You know, like, and they can have that conversation and like kind of like, but I don't see as much the other way. I think there's a good amount of fintech stuff in Austin. It's not like
it's not super huge,
you know. So if anything, I think the most interesting thing is if it was a place you wanted to invest your time. And
Yeah.
I think the most exciting, most interesting thing would be like, what things could we do to help cultivate the fintech community more?
Yeah, we're involved
You
in
know,
Austin
like,
Tech Professional
and like
Association.
do things to try to help. But that's more on the startup side.
Yeah.
Make more
No,
activity.
absolutely.
That's kind of stuff we could help with, and we
Okay.
can, you know, and potentially bring in other like, you know, NetSpend has
Oh,
4
absolutely.
floors in this building, right?
Absolutely.
You know, and they're one of our partners, and there's other BBVA we do much work with. So like, you know, there's potentially some stuff we could do to bring together some people who do stuff new,
Yeah.
and that's what I think would be most interesting. There's
Yeah.
just not enough going on.
For that, because I mean, I can talk, sorry, I've heard so many, I can tell you in 10 minutes, you know, I know what you're doing, I know how you're doing it, I know what your time problems are gonna be, especially if you wanna partner with a bank.
Yeah.
Because that's a big, huge issue.
Do you know student loan genius? That's another one of
They're a
ours.
client.
Yeah, they're awesome.
Yeah, and Henry Yoshida and I are, we go back a ways.
Oh, hey.
But just here is a
How are you?
resource for when you guys
Ah,
run into
okay.
that. We love to get on the
Hi.
front because sometimes.
I forgot your name,
Do
though.
the transfer twice,
Paul.
so it's
We
a
have
problem.
Yeah.
Plus
No, I
we're
mean,
watching the regular
SLG is
changes.
the most interesting one.
Yeah, they're great.
That space right now.
No, absolutely.
And then,
Wait, so
yeah,
were
we
you
had some
in
stuff,
session
people do
here?
some stuff in a little bit of
Do you
Bitcoin
know
and
why?
things, you know, like that might be some bit, but we just don't.
Oh, okay.
We rep Self-Wonder too, they came out of Techstars.
Yeah, yeah.
But, good guys, but thank you for
I'm
having
an
us
investor in
on.
that.
Are you?
too, so.
Oh, nice. But we were just really,
Yeah.
I wanted to get the accelerator information because we do have, you know, clients. that-
Okay, yeah, well, that's what it
Hey, we
said.
got this wonderful idea, it's like, hey, you have no money, so we're gonna get us.
Yeah. Now this wasn't really about the accelerator. Art we actually revamping our accelerator, so we're making a bunch of big new announcements next month.
Oh,
so
nice, okay.
Stay tuned.
Follow
There'll
that.
be some more too.
But I just wanted to meet you because everyone says you gotta meet Josh.
Nice
to meet you.
Thanks for coming out.
Oh, I saw the Obama picture right there. There you go.
Hey, how's it going?
Drew
We'll swap
Peters.
that out.
Quick question for you. So I just moved from Atlanta. I've been with Card and Virtual Startups, and I'm spinning off a company I sold in 2014 called Claim Inc. Is the one that we started. Do you have any recommendations as far as like startup attorneys that you recommend over others?
I mean, yeah, there's a bunch of them. Kind of thing. But,
Yeah.
what I would do is I would go to you know, the Austin Startups Facebook group.
Yeah, no, I've spoken to like 3 or 4 of the big ones. The ones I was going to reference, Jose.
Those are all really good ones.
Okay, I didn't know if you had a personal favorite that you would
No,
recommend.
I mean, I do a lot of work with, particularly Jose and Emma. They're both really good.
Okay, cool, man. All right, thank you.
So you got the good recommendations.
Okay.
How's it going?
Nice to meet you, Danny. Hey, Danny.
So the second question I was trying to ask was, I have another B2B SaaS business, and it's a very niche market, so I bootstrapped it myself pretty much the whole way. But eventually, the concept is that I could apply it to pretty much all other industries, not in my niche specifically. So should I look for funding to expand into the other industries and other markets, or should I try to just naturally try to flow into it without?
It was that chart.
Yeah. So
is it capital intensive?
No, it's not. It is
Very competitive?
It is. It could be.
That would be the reason to maybe raise money.
Okay.
If you feel like you need that money to be competitive.
Yeah. Okay. Cool. All right. Thank you, man.
Cool.
Take care.
Josh, hey, Adrian Early.
Hey, hi.
There's a lot of talk about fintech.
And they give a little bit of seed funding.
I've innovated in the nature of a financial service. So I wouldn't call it fintech,
That was
okay,
like
but it's
$5,000.
changing the very nature of the service itself. So, any reaction to just that?
I don't really know what you're talking about.
So, on top of a wealth management platform,
What are you hoping to get out of this conversation? I'm not sure what you're what's the. Do you want feedback on your idea, or you like?
Sure.
What, no, why did you? I'm not looking for an I'm sure. Why did you come up here? What were you hoping to get out of it?
I wanted to start a conversation with you because I've invented something that I believe will replace the insurance industry.
Got it. Well, you know, I'm definitely a business guy. Like, I'm probably not the right one like full structure and things like that. I think
Either they're YEC or Techstars 4, they take.
Do you need funding for it? Like, what's, where you just?
I think we actually likely don't need funding. We're sort
So what
of
kind of
right
help do
on
you
the
need?
edge.
And did you have
So what kind of help do you need?
Well, we're actually starting to